Phoenix Mills surges over 3.5% after Morgan Stanley issues an overweight rating to the stock. The brokerage raises its target to 1,700 rupees a share, with the company looking to double its rental portfolio over the next 3 to 4 years.
Mahindra & Mahindra opens lower, but it's recovered slightly from the day's low after BofA Securities downgrades the stock, citing an uncertain farm outlook and a lack of meaningful catalyst.
Crompton announces the merger of Butterfly Gandhimati with itself, with a share swap ratio of 22 shares of Crompton for 5 shares of Butterfly Gandhimati.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and join me is Mangalam Malu. And as we speak, the Nifty is up close to around 85 points odd. Remember, you're expecting some bit of resistance to come in at around 17,100 odd. The Nifty has recovered a good 100 points from the low point of the day. And the Nifty Bank is doing pretty well. That's up close to around 100 points. But the reason that, in fact, the Nifty has moved to the day's high is because big boy, Reliance Industries, just pull up the intraday chart out there. That's powering ahead, and that's a heavyweight in there. And from the word go itself, you have the Pharma index that's making a bit of a bounce back. So, that's moved to the high point of the day as well. The Pharma index on the whole should come up for you on the screen. How to trade the index from here, though, at around 17,030. Shivangi Sarda joins us to tell us exactly that. Hi, Shivangi. Good morning. What's your trade, Shivangi? Do you think the Nifty has enough triggers to move higher from here on? Or would you consider taking a short position around these levels?
Yes. Hi, Nigel. Good morning. Thank you for having me on the show. So we've seen that Nifty has got stuck in a very narrow range from the last 7 to 8 sessions. Now, as we move ahead to the monthly expiry for the March series, we are seeing that the volumes are quite shallow because of the various, triggers that have been coming in from the global bourses as well as our market. Now, the sector specific, if we, talk about some of the sectors are supporting the index today. Even heavyweight stocks are supporting. So somewhere the bounces can be seen, of course, but the absence of follow-up buying at higher zones is somewhat creating a kind of a negative for the market. So we could see a bounce towards 171 levels, but overall pressure is to remain, and the lower levels to watch out for would be 16,850 levels. So the index is likely to remain in a range of this sort. Talking about Bank Nifty, it comparatively it was in less weakness from the last 2 sessions as compared to Nifty, and today we've seen that it slightly breached the low of the previous session, but then again bounce was seen, and it is holding well today as well. Because of the support of the heavyweight banking stocks. So now looking at Bank Nifty, the levels on the upside are 39,750 and 40,000 levels, and on the downside, one could watch out for 39,000 levels.
All right, those are individual index levels. Just a word on some stocks, Shivangi, because Reliance, as we pointed out, has seen a big surge from the lows, currently at the high point of trade, supporting the index. But usually what happens is that if you have one stock supporting the index, any bit of weakness in that stock takes the index down with it as well. Your thoughts on Reliance and the other stocks that you have with you?
Absolutely, Mangalam. So, we've seen that this kind of a market that we are trading in now from the last, 2 months, slight triggers are actually affecting the market, and the market is not being able to hold at higher levels, which is a cause of concern. Even the volatility index, that is India Mix, is at higher zones and is not cooling off. So this is also one such trigger which is acting on the market. Now, talking about Reliance, of course, we've seen some sort of, strength today, but then on my radar today is ITC. This stock is coming out of its consolidation on weekly frame and holding well despite all the market volatility. Now, this stock is also getting tailwind from the entire sector, as some of the other names like Dabur is also doing quite well. So we are seeing the previous day short, which is being covered, and the overall increasing rollover as we head towards the monthly expiry week is quite remarkable. So recommending a buy here with a target of around 395 and a stop loss near 370 levels. My second pick on radar is Dalmia Bharat. This stock has negated its lower highs on weekly frame, and thereafter follow-up buying can be seen in the stock. So, this stock is looking quite good on the charts technically, and the derivatives data are also indicating a good potential of an upside, a good risk reward at these levels. So, recommending a buy here with a target near 1920 levels and a stop near 1810.
All right, Shivangi, thank you so much for joining in and giving us your calls on the index as well as individual stocks. Let's talk about our special segment, Ideas for Profit, coming in from our colleagues at Money Control Pro. Nitin Sharma joins in with a stock that he's tracking.
We recently looked at Mahanagar Gas post-acquisition announcement. Mahanagar Gas has been under pressure for some time due to high input gas cost that eroded its margins. In the previous 3 CGD bidding rounds of PNGRB, Mahanagar Gas couldn't win a geographic area, and last one it added was in 2015. Recently, company announced acquisition of UEPL for 531 crores in all cash deal. It has 3 geographic areas of Ratnagiri, Latur, Osmanabad, Chitradurga and Devanagari. In the FY22, company had a revenue of 89 crores along with a net loss of 24 crores. In a 6-month FY23, its volume averaged at 6 lakh SCM daily, 90% of which is CNG. MGL plans to invest 1,000 crores in the next 7 to 10 years to ramp up its volume to 1.1 million SCMD. LNG prices have been down to $13 MMBTU in the last 6 months due to weak demand from Europe. Propane prices have gone up by 22%, and that is reviving shift toward gas by the industrial consumers. Also, government policy now requires HPHT gas producers to offer their volume to CGD companies on priority basis, which should bridge the gap of the APM gas shortage and further bring down the cost for Mahanagar Gas. Stock is trading at a FY24 P of 11.6 times, which is below its long-term average forward multiple. Among the CGD companies, MGL enjoys a relatively strong position, and in our opinion, investors can add the stock on declines with a medium-term view.
Okay, all right. Thanks a lot for that, Nitin. Well, on that note, though, we'll slip into a short break. On the other side, we'll be joined by Mr. Sharma, the head of digital channels at RBL Bank. We'll discuss the launch of the new RuPay card for Metro and also the outlook for the digital banking. Stay with us.
Welcome back. As promised, let's get chatting with the management of RBL Bank. Pushpendra Sharma, who's the head of digital channels at RBL Bank, joins in to discuss the launch of their new National Common Mobility Card, NCMC card in Bengaluru, and at the same time to discuss the outlook for digital payments on the whole. Thanks a lot, Mr. Pushpendra, for joining in. You know, before we talk about the new card that you've launched and the impact of digital and UPI, etc., on the credit card environment, we have some data for the credit card segment for the month of February. Total card issuance was up just about 1.1% month on month. The average ticket size was down by 8.1% month on month. This is for the entire industry. You look at credit cards as well as the digital channels at RBL Bank as well. What do you make of these trends? Why is it that, average ticket sizes are going down, new credit cards, being issued are slowing in their pace? Is it because of the advent of other alternatives like UPI digital and because of some of the charges that banks are laying on, say, rent payment via credit card, etc.?
Yeah, good morning, Mangalam. Thanks for having me on the show. You're right and wrong in your assessment. There are various regulatory developments which have come in past few months, and I guess all credit card players and all digital payments players are adjusting to those changes. So in this period, while every player is sort of upgrading their systems and processes to meet the regulatory bit, the transactions are more or less same, but the regulatory sensitivity and some of the trends which have picked up in past 2 years, namely rent payment, there have been some developments from networks also where they have, made banks aware about the potential risk of these new modes of payment. And everyone is waiting and watching. In your experience, you would have also seen that some of the banks have also changed their terms and conditions starting April. So I guess, this is a transitory period where the new trends and the pattern new modes of payment and new use cases are finding their feet, and the ecosystem is now sort of absorbed those changes and taking things as they come. Regarding the ticket size and the card, the number being used, I guess the base effect of COVID has now stabilized and the numbers are more normal and more even. And these will be, I guess, the standard growth rates you will see across industry, I would assume.
All right. Hi, Mr. Sharma. But could you give us an outlook both on card issuances as well as on spends? How do you see that shaping up? And also, you all had a tie-up, right, with Bajaj Finance. How is that shaping up?
Nigel, you'll have to excuse me on this question. We are in a silent period just before the year end, so I guess you'll have to wait for this details and answers in the analyst call post the year end closing. I'm sorry for that.
Right. But, it's not about just this quarter. What I presume Nigel would have wanted to know is a much longer term horizon as well, which I don't think should be affected as much by the silent period, so to say. We're not asking just about the fourth quarter, but a larger opportunity.
We're not asking the near-term numbers, sir. We're asking you, how do you see this, the growth numbers move out for the credit card space for your bank on the whole? You could give us an outlook for FY24. We're good with that.
So I think the trend we see inside the bank is that the consumer demand is robust. The demand for credit card across all the variants is very much there. You will see new tie-ups coming up, going live very soon. The regulatory developments where the card issuance in 30-day period had to be made live, otherwise the card will get automatically cancelled. Everyone is sort of adjusting to those new regulations and changing their systems on how customers will see omni-channel experience, and then customer onboarding experiences are smoothened. So all those developments notwithstanding, I think the growth is very much there. You will see growth happening. That's what I think I can comment at this moment. The quantitative bit, as I said, you have to just wait for those numbers. Regarding a larger trend on digital, I guess credit card is just one bit of it. We are seeing traction all across digital banking, digital lending, and payments. Payments bit is picking up pretty fast. UPI story is well documented in the country. You see billion transactions every day. We are seeing growth not just on UPI on retail bit, but institutional bulk users. And with IPL coming up next week, you will see a lot of traction, and are we looking to gain market share on UPI too? So you will see all-round growth. That's what I can tell you at this moment.
Okay, all-round growth is what you're gunning for. Just a small little word on the NCMC card. What's the scale, the business opportunity here? I ask this primarily because, I don't know, as an individual, both Nigel and me, we've started using a fair amount of digital payments, mostly backed by UPI. We don't remember the last time we actually swiped our credit cards or tapped our credit cards in a lot of places. So the use for a credit card, the use case for a credit card seems to be declining. That's anecdotal evidence. I don't know, how the trends are macro. And with this NCMC card, what benefits does one get? They get a credit card. Do their tickets become cheaper?
It's a great question, and I'll take a few seconds to explain what NCMC is about. We are the third or the fourth. We're the second bank, or possibly the third bank to launch NCMC in the country. NCMC is a contactless prepaid card. You load the value. The use cases currently are ticketing, gating counters at metro station. The vision of NPCI is to make this card is interoperable. That's the best feature here. The interoperable card can be used anywhere in the country where public transit infrastructure is being put. So you can use a Bangalore Metro card, which we launched recently. The card can be used in Delhi Metro, Mumbai Metro, other metros in Pune, Kochi, Nagpur, wherever metros are operational, this card can be seamlessly used. The metros which were launched earlier had closed loop card. The card cannot be used for parking, toll, bus transit systems, or e-commerce transactions. Those were really the shortcomings. This card not just is interoperable, but also can be used for your shopping, cash withdrawal, toll parking, bus transit. So I guess it's a one-stop solution under the government vision of one nation, one mobility card. The card will see evolving into getting co-bundled with debit card and credit card. So your EMV chip, which you see on the card, will be used everywhere. The pricing question, I'm sure that with bundled offers, the prices for travel will go down, and as banks look.
Right. Take that point. Unfortunately, we here in Mumbai cannot avail of this yet, primarily because our metros aren't fully constructed. But just last one question from my end before we let you go. You have tied up with Bajaj Finance. You said digital is doing well, UPI is picking up as well. But a lot of these new BNPL players, new fintech startups, can we hear of you collaborating with any of them in the near future?
Mangalam, before I answer that question, one bit of information for you. You can use a NCMC card issued by other banks also on Mumbai 1 and Mumbai 7 lines. They are operational. Bangalore Metro is currently live with 63 stations. 5.5 lakh cards are issued. 3.5 lakh people use it daily. In 1 year, we are looking at doubling this number. So it's a tremendous opportunity, not just in Bangalore, but elsewhere in the country, because once you get a card, you can use it elsewhere. Regarding your questions on partnership, we are known in the market for doing a good bit on partnerships. We have done well in the partnership startup ecosystem. We continue to do well. We welcome all startups, who are looking to have a defined use case. But please note the regulations have come of age. Regulations have evolved. The licensing regime has come for most of the startup players, whether it's lending, payments, payment aggregator. So all startups are welcome to deal and work with RBL Bank. Just the bit is that the climate is the regulatory environment is very different now. If there is appetite, there is use case, everyone is welcome to work with us.
Okay, all right, Mr. Sharma, thanks so much for stopping by and giving us insights, into this aspect. Good speaking to you. Look forward to having a chat with you in the coming weeks as well. Well, for the time being, though, we'll slip into a short break. You come back, we'll continue our focus on markets and stock-specific action. Welcome back. Well, the markets are struggling to stay at those elevated levels, and we're back down below that 17,000 odd mark. The Adani Group stocks, that's Adani Enterprises and Adani Ports, both of them have moved lower. But a couple of these larger names, particularly the banking names, ICICI Bank as well as Axis Bank, they have moved down. And that's why the Nifty Bank has now moved into the red. So just keep an eye out on the Nifty Bank. You would want it to cross the 200 DMA. Well, for the time being, it's finding resistance at those levels. But from the broader markets, Phoenix Mills, that stock's doing well. There was another brokerage upgrade that came in earlier today. Sonal joins us to give us, the rationale and the details of that report of Morgan Stanley. Sonal?
Thank you so much for that. Well, it was Motilal Oswal last week that initiated coverage on Phoenix Mills, and today it's Morgan Stanley that they have an overweight rating on the stock, and the target price that they've set is 1,700 rupees per share. They say that the company has a well-located mixed-use destination malls, and they are set to benefit from India's consumption growth, which is expected to grow at a faster pace. Plus, the company is in an expansion phase, and they aim to more than double their rental portfolio next 3 to 4 years, which could be the big trigger for the company going forward as well. The planned expansion of retail assets is from 9 million square feet, that is in FY22, to 21 million square feet by FY27, for which they have added new land and new parcels and new malls as well in their portfolio. This expansion should drive EBITDA in terms of growth of around 27%. This will be over the next 2 financial years, and that's why they're bullish on the stock.
All right, Sonal, thanks a lot for that. That explains why Phoenix Mills is up almost 3%. But one of the stocks which has fallen about 5% from the highs that we saw on Friday. 9 minutes of trade, we got the news on Nykaa that 5 executives of the company have resigned from their roles. And this morning as well, the stock is down about 2.5%. The resignations include the likes of the Chief Commercial Operations Officer, Manoj Gandhi. We have Gopal Asthana, who's the Chief Business Officer of Fashion Division, having resigned as well. Alongside that, we've seen some resignations in the CEO of wholesale business as well, Vikas Gupta, and 2 VPs of the fashion business have resigned as well. All of this follows the spate of resignations that we saw between August and February this year, where we had the CEO of FSN Brands Reena Chhabria resigning in August. We had the CTO Sanjay Suri resigning in November, and Arvind Agarwal, who's the CFO of the company, resigning on November 25th. The company on its part has said that voluntary and involuntary exits are expected in a company which has a strength of over 3,000 employees, and some of the mid-level exits are a part of the standard annual appraisal and transition process. Jefferies has spoken to the management and they've come up with their takeaways. They said that the company to them has said these departures are very small in the context of the overall company size. Secondly, some departures are based on performance, so which is not entirely voluntary. Maybe the company has spared non-performing employees. Thirdly, the Nykaa team, we've been talking about competition, right, has been very sought after by competition. So there would be normal attrition that, these companies will see, and they will replace these guys with a mix of in-house and external talent. What we need to see is the impact of these resignations on their performance, and secondly, the impact of these resignations on their employee cost base. Were that to, reduce, then we can obviously automatically see the margins improve, and if that happens, then the thesis of operational performance improving goes forward. Jefferies has a buy rating on the stock with a target of 200, so maybe their views are also mirroring their opinion.
Okay, all right. Well, let's focus on Dalmia Bharat. Late last evening, they announced to the stock exchanges that they'll be exiting that 42% stake that they had in Dalmia Bharat, the Refractories Limited. They're selling it to a promoter entity itself. They're going to be receiving close to around 800 crores, and the transaction will be consummated in the next 30 days. They've given the timelines as well with regard to the payments. 20% they'll pay right up front, of around 160 crores odd. The remainder they'll be paying it in two installments of around 40% each. That's 320 crores odd, and that will be in the form of NCDs, for which they'll be at a coupon rate of around 8.5%. Why is this positive? Because they've said they want to focus on their core cement business and sell all unrelated businesses. So that's what they're doing. The cash balance goes up as well. And remember, they are in expansion mode. They have a 100 million ton target going ahead. So that's it helps that as well. And the street was a little bit cautious that maybe they'll do some inorganic growth, but in an unrelated business. So now if that is the case, it's likely to be done at the promoter entity end, not by the listed company. So put all this together, and the street is happy with this outcome. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.